Okay, so today we're going to learn about the accounting equation and also some basic information about the financial statements. And so we'll start out with talking about the fact that financial statements, we'll talk the financial statements first. And we're going to just like think of it as sort of like it's just pieces of a puzzle. And that's really what it is, because all the pieces kind of work together and they tell the picture of what's happening in the company. And so I always think of it like game stats, because I had this mentor who taught me a lot about how to teach accounting. And she always used these sports illustrations because she's a real sports kind of person. She follows sports and I like sports, but I don't know as much about it as she did. But still, it makes so much sense to me when I think of it the way she told me, which was just thinking of the financial statements sort of like you would the statistics that you have for a ball game. So for instance, if you were following a baseball team and it was your favorite pastime is to watch every game that your team played, and this one day though you had a conflict and you didn't get to see the game, so what you would do is you'd like find all the information you could possibly find about what happened in the game, because maybe you couldn't get a recording of it. Maybe you didn't know anybody personally that had been at the game, but you're like determined to see what happened in the game, because what you were able to find is the ending score of the game. And so you could see, well, maybe your team lost or maybe your team won, but you really didn't understand why it happened the way it happened, because the score just maybe seemed out of line for what you expected against this particular opponent. And so if you did that, you would go searching for all the information about the baseball game. And so you don't want to know just the ending score. You want to know, how did everything go all during the game? You want to know the pitcher data. You want to know the earned run average. You want to know the batting average and the stolen bases. Everything, every little detail about your team's game is important to you. And that is the way it is with financial statements. So each of the different financial statements, the major financial statements, tells you a different piece about what happened to the company. So I'm going to take it then to each of these little statements and give you just a brief overview about what each of them is explaining about the company. So first we have the income statement, and that is just a statement that's for a period of time, like usually for a year or could be for a month, maybe even for a quarter, but it's telling what happened to the company, their profit and loss. So it shows all the revenue for that period, and it shows all the costs that were related to those revenues, the expenses. And so what they wind up with is a net profit for that period of time, so that you can see how well they did for that year or that month or that quarter, whichever the income statement is presented for. So it's really like a moving picture. It's like, let's see what happened for this whole time period. And so that's one important statement. Then another one that's also for a period of time is for that year, or maybe if you're reporting on a quarter or a month, it's for that shorter period, but it's for the same period of time that matches the income statement. And it's just showing what changed about the owner's equity. So sometimes the owner invests more in the company in a year, puts more cash in or puts some other assets in, and that is an increase in their equity. Or sometimes the owner pulls out some cash from the company. And in the case of a proprietorship or a solo company, like we'll be studying in this class, there's the owner might take some out as a draw. In other words, they pull some money back out of the company once it starts making some profits. And so that's owner's equity statement shows what happened to the company, whether it was from owner investments, owner withdrawals, or from earnings that the company made that increased the owner's share or the owner's worth. Okay, so that's a statement of owner's equity. And then the next one that's for a period of time is a statement of cash flows. And it just shows what cash came in and what cash went out for whatever reason that the cash was moving. It just shows like a summary of all the cash that came in from different sources and what it was used for, so that you could compare your beginning and your ending cash and see why it changed from the beginning to the end. But all these three are for this period of time that's usually a year, but sometimes it's a month or a quarter, could even be a week. But mostly it is for a financial statement is prepared on a longer basis than a week usually. And normally it's always done at the end of the year and sometimes done at interim times during the period. Okay, so those three are all for periods of time. And then there's one that's different of the four major financial statements. It's the balance sheet. And the balance sheet actually talks about what status the company has at a point in time. Instead of for a period of time, what happened, it shows where do we stand on the last day of the period. And so the balance sheet is important too, because it shows all the company's assets that they own and all the company's debts that they owe, plus whatever's left that the owners have a share of. And so another name for the balance sheet is the statement of financial condition. And generally, very few people call it the statement of condition unless it's like a big company that's following GAAP rules. So individuals that just commonly discuss the financial statements usually say balance sheet when they're talking about the report of assets, liabilities, and equity. Okay, so each of those statements connects to the others. And so as we get further into this course, we're going to learn more and more about how they work together and how important it is that one flows into the other. Okay, and so now there's elements within these financial statements. The income statement shows the revenues, which is the amount of the price that's charged for the goods or the services that the company sells, and then the expenses that are related to that, the cost of the things that are used up to make that revenue. Then it also can show gains that are not related to the operations, but they're from selling some business asset. And then we'll talk about that one later. That one's not going to be a big factor in what we're learning right off. And it may even be in the next course, but it will come up in accounting. And then losses, similarly, if you sell something and you get less than you paid for it, then that would be a loss. But these are for losses that are not directly related to the operations of the company. So it's not the sale of the goods that the company's selling to customers. It's more like they own a building or they own some equipment and they sell that separately. So again, we're not going to cover gains and losses right now. And we may get to it before the end of the course, but if not, we definitely get to it in the next accounting course. But when you get through with presenting these on the income statements, you've shown your income, the revenue, you've shown your expense, then you've shown any gains or losses, and you combined all of those to come to what's called a net income. And really that's, for our purposes, it's just thinking of net income as revenue minus expenses. If you had gain or loss, it would add in. That's not always present where revenue and expense is. Okay, so that's the income statement. Those are the elements that are included there. Then the balance sheet has elements also, and these are the assets, the liabilities, and the equity. So assets include everything the company owns. So it would be like the cash in the bank, it would be equipment, land, it would be automobiles, anything they own that they can use as a resource in the company, then that is an asset. Even receivables that other people owe them are considered an asset. And then liabilities would be anything that's payable or due. And then later we'll pick up another term called unearned. That's also a liability, but it's basically liabilities are something we owe. And so we owe to an outsider, not to the owner. We owe to an outsider something. That is why we call it a liability. Okay, and then the last element that we'll talk about at the moment for the balance sheet is equity. And that for us in a sole proprietorship situation, that the equity account is called capital. And we'll talk further about that. And capital includes, a lot of things, which we're going to get to in a moment. Okay, the retained earnings of a company, if it were a corporation, they would use the term retained earnings. But if it's a sole proprietorship, they call the amount that's retained in the company capital. And so that is just the net income that they keep in the company. And that's the part that is left, that remains there, that hasn't been withdrawn by the owners. And so net income is revenue minus expenses. You could keep it in the company and it would increase capital, or you could pay it out as a return of capital to the owner. And that would be drawing. So there's another term for drawing called withdrawals, but they mean the same thing. So basically, if whatever the company earns for that period of time increases the capital account, it's retained, but as part of the capital. But if the company gives some of it back to the owner that as a draw, then that would be considered a reduction in the capital. And so that's just how you keep track of what the capital balance is however much earnings, however much equity is left in the company and not distributed to the owners. Okay. Okay, here's some interchangeable terms: profit, earnings, and income. Those terms are used throughout. I'll use them all the time. The textbook uses them all the time. And when they say profit or earnings or income, they are almost always interchangeable, especially if they use the term net income along with profit or net profit, net earnings. Those terms are very synonymous. Okay, now the next thing, we'll talk about the accounting equation. Very important concept, and it's something that you got to get your head around, but it's really not complicated once you get it. So basically, thinking of it, look at this little box I've got here. This is what I call Miss Roscoe's box, because she was my mentor and she taught me a lot about how to talk about accounting, how to make it clear to students. And so this box that she used is really just saying that the company has this group of resources called assets, and everything the company owns is considered one of those assets. So you've got this total number of assets, the value, the cost value of them. And so that value is made up of everything the company owns. And there's a claim against every one of those assets. So the claim against the assets is the two things combined, liabilities plus equity. And so the resources of a company is all equal to the claims, because there is a claim against every asset the company has. There's a claim that the creditors have because you got to pay them back. And then everything that's not owed to the creditors is owed back to the owners. So those claims equal the same total amount as the asset total. And so that's why the accounting equation always balances, because the total assets is always equal to the total of liabilities and equity, because there's one of those groups has a claim against every resource the company has, either the creditor or the owner. Okay, so liabilities are the part that is owed to the creditors. It's what you owe to outsiders, but also that's called the creditors. And liabilities, another name for that is debt. So you have liabilities, which is what you owe to outsiders, and then you have equity, which is owed to the insiders, the owners. So you got owners' claims and creditors' claims. Those two together will equal the total of the assets. So that is why the accounting equation works. So let's look at this before we get to the accounting equation piece. Let's look at this for a second for this example. Let's say this company has $700,000 worth of assets, and the creditors, they have a claim of $150,000 because we owe $150,000 if we're the company. So if we own assets of $700,000 and $150,000 is owed to the creditors, then that means all the rest of our assets have a claim against them. Also, they have a claim by the owner, because just think of it: if we distributed all the assets of this company, we would have to first pay the creditors. And so in our case, if we had the $700,000 worth of assets, let's just say for granted that the assets were valued at the same amount that our book was carrying them at, just so it's easy to understand. So $700,000 worth of assets. If we decide to liquidate the company and distribute the assets, we have to pay off the creditors first. We pay the $150,000 to them, and then we're left with $550,000. We're going to distribute that to the owners. And so that's why the claim that the owners have is $550,000, because their claim is limited to the total assets minus the claims of the creditors. Okay, so that's why this equation, assets equals liabilities less equity, is always correct. No matter what happens, the total of the assets has a claim against it by either creditors or owners. So assets equals liabilities plus equity. And just because we know that we can turn around any equation, just like we learn in simple math, is that if you know assets equals liabilities and equity, that means you could subtract liabilities from both sides and you'd wind up with assets minus liabilities equals equity. And by the same token, if you had assets equals liabilities plus equity, if you subtracted equity from both sides, that means that you would come up with assets minus equity equals liabilities. So these three ways of looking at the accounting equation can help you if you have a situation where there's a piece missing and you don't know what the total of the liabilities is. But if you know what the total assets is and the total equity, you're going to be able to tell what liabilities are. So we're going to have exercises. We're going to work on this. And that makes it easier to understand if you see why they can be turned around in that way. Okay, so just a little reminder here about examples, what is included in assets. It's all the resources of the company, like cash, accounts receivable, supplies that's in an inventory, prepaid insurance, which is something we'll talk about a little more later on. But basically, it's just where you pay the insurance up front, but it's for a future period. And then maybe land and equipment, lots and lots of other resources the company could own that would be assets. And then liabilities, something that's due to others, due to creditors, same thing, or think of it as debts. So it's going to usually say accounts payable or unearned rent or note payable. So unearned rent would be like, or it could be unearned revenue. If you collect something in advance, but if you haven't really earned it yet, that means you owe the other party, your customer, the service that you owe them or the goods that you promised them. And so if you collected something in advance from a customer and you didn't provide the goods or services, then you have an unearned revenue account. And that's considered a liability because you owe them the product or service that they paid you for. Okay. All right. And then equity. We talked about this a little bit, but the equity is the amount the company owes to the owners. That's your capital account. But it's another equity account that is what you call a contra equity account is the drawings account. It's just keeping track of how much the owner has withdrawn for this period. And then you have the net income affects equity, even though it's not actually an equity account. But everything that is revenue and expense affects equity because revenue increases the equity. If you get more sales, if you get more income coming in, it's going to increase your owner's equity. But if you pay out costs that relate to that revenue as expenses, that's going to reduce your equity. So that's why I put them here as alsos to the equity, because they affect the equity, even though those are not actually equity accounts. If you had to peg them, though, as either asset, liability, and equity, you would have to put them drawings, revenues, and expenses as they affect equity. They would not be assets and they would not be liabilities. Revenue, expense, and drawings are sub-accounts that will feed into equity eventually. Okay. All right. So here's a little chart that I think helps. And basically, it's just the accounting equation. Assets equals liabilities plus equity. And under equity is these four things I just talked about. The capital account itself, which is the amount that the owners have invested. And then the drawing, which is the amount they pulled back out. And then the revenues that were earned this period. And the expenses that were paid out relating to that revenue. So the equity is a combo of capital minus drawing plus revenues minus expenses. And that's because drawing and expenses reduce equity. Whereas the capital account increases equity, the revenue account increases equity. But drawing and expenses reduce equity. Okay, so that's all I have for the explanation of the chapter. There's a couple of terms in here about accounting assumptions or concepts. So you should look at that. You should look at all the terms at the end of the chapter, make sure you understand all those. And then we're going to work some exercises in another video that's going to help us to actually put some numbers to this stuff. Thanks a bunch.